Every investment decision that you are making should be backed by information. There is what you have analyzed in order to arrive at a conclusion to put your money in a certain vehicle, having compared an array of options that are available to you. If you are choosing between two options, and in this case, I want us to look at the option of investing 100,000 in a money market fund or putting the same 100,000 in a different option, and we are looking at a 1 year Treasury Bill. That is the Treasury Bill for 364 days. Once you have assembled your capital or you have your amounts that you have accumulated and you want to look for opportunities where you can multiply that money or grow that money, you have to analyze all those opportunities or investment vehicles that are available to you to choose the most appropriate that will give you the desired results or give you the desired goal to which you have attached a purpose, because investment without a purpose, you'll be doing a lot of nothing. So now, if today you invest 100,000 in a 364-day Treasury Bill, when you are bidding the face value of 100,000, you'll be required to pay an amount of 91,877.4 as per this schedule. I've used the CBK calculator for ease of determination. The reason we are paying less than the face value is because the Treasury bills are issued at a discount. They are auctioned at a discount. That means you give CBK a lesser amount than the face value, but you get the face value at the end of the investment period or on maturity, which is supposed to be after 364 days. But the decision to invest, you had already assembled or identified the capital that you want to invest, and it was 100,000. On the basis of the principle that no money should be left idle, that capital that you are left with as the discount amount on the auction of that Treasury bill need to be invested somewhere, because 8,122.6, which will be the discount left or on us for that investment, need to be invested. And because it cannot buy another Treasury bill, our optimal choice would be have it invested in a money market fund for purposes of compounding. So for this one, we are looking to analyze the two options between a money market fund and a Treasury bill. Which one will grow your capital more compared to the other? Because at the end of the day, we are looking at building our desired capital. The goal is a certain amount of money that you want to be assisted by the specific vehicles that you are going to choose to build towards a specific amount of capital at a certain point in time after so many years. Then after that, once you attain that amount in the desired year, there is a purpose that you are going to attach to that goal. Possibly for somebody, it could be a purpose of utilizing the accumulated capital for generation of constant, regular incomes to support them during retirement. For another person, could be to use that amount to buy a vehicle and whatever remains, continue running that vehicle, or whatever other goal and purpose that you attach to your investment. So in our today's analysis, we want to look at the option whether it's better to be in the Treasury bill investment or you are better off holding that investment in the money market fund. This schedule that we have identified from CBK calculator on your investment of that Treasury bill has given us the total amount that you are paying will be 91,877.4, but the net amount that will be remaining on you as the discount is 8,122.6. We are using the prevailing market interest rate on Treasury bills, which stood at 10.5941%. If you are to subject that rate to the face value of 100,000, you'll be getting something in the neighborhood of over 10,000. But because these instruments are taxed, that amount will be subjected to a withholding tax of 15%, and that's why it will go down to a figure of about 9,004.985. But to arrive at the 8,122.6 is because the 9,004.85 is a future value. It's a value that your 100,000 would have attained having invested for a whole year. And because the discount is arrived at 0.0, which is at the beginning of your investment, we have to determine what will be the present value of that future value of 9,004.985. And when we subject it to a discounting factor, that's how we are arriving at 8,122.6. And analyzing that difference, you realize that the discounting factor is slightly less than the prevailing market interest rate of the Treasury bill. So taking the 8,122.6 discount and reinvesting it in a money market fund, because we want to determine the total amount that we shall be having on the investment of 100,000 in the Treasury bill at the end of the year. So we have to reinvest this amount that we are left with in the money market fund, and as per this schedule, the reinvested 8,122 in the money market fund will grow to 9,242 in the same money market fund that we shall use to determine or analyze the investment of 100,000 in full in the money market fund for the same period of time. So in total, if we take this 9,242.639 that we are getting from investing, the 8,122.6 as the discount, and the 100,000 that we shall receive from CBK upon maturity of our Treasury bill investment, will realize a total of 100,009.242.639. That will be our total amount at the end of investing 100,000 in a Treasury bill. Then the option 2 is the money market fund. If we were to allow this amount to rest as invested in a money market fund for a whole year, a money market fund is equally taxed at a withholding rate of 15%. And therefore, this first schedule, I've calculated that investment without determination of that tax, and would arrive at 116,412.34. If the same amount is subjected to tax, it is the rate that will change. And 15.92%, when you subject it to a 15% withholding tax, you are getting a net return of 12.92%. So as per this schedule, net of tax, our 100,000 in the money market fund for a whole year will yield 113,789.167 as the total amount. So simply analyzed and stated, the money market fund total of 113,789, if you compare with the total of 109,242 that you are getting from investing in the Treasury bill and compounding the discount, you will conclude that you are far much better investing that amount in the money market fund as compared to the Treasury bill. And that is the rationale that you are better off investing your money in the money market funds compared to the Treasury bills. And in most cases, we are looking at those money market funds that are genuinely and literally giving us competitive returns compared to the rest. And for this one, I've chosen a money market fund that is ranked number 6 in the performance list. I avoided using the lowest performing money market and the top money market fund for purposes of avoiding the outlier errors. So we need now to look at what are some of these reasons that make the money market fund better than the treasury bill, and we shall looking at the specifics that make the two options different after 3 seconds short break. So don't go away. In the meantime, as always, give a like to this video and engage in the comment section. And you can also share the video if it has value. See you after 3 seconds short break. Welcome back to the specific reasons why the money market fund becomes a better option for investment than the treasury bills. Number one, we will look at the tax advantage. And this is in comparison when we are looking at pushing that investment to a bond. A treasury bill does not give us any tax advantage when we are comparing it with a money market fund, because the two options are taxed at the same withholding rate of 15%. That tax advantage would be very beneficial if you are comparing a money market fund and a bond, because bonds will give you a tax benefit or a tax saving of at least 5% to 15% depending on the type of bond that you want to purchase. But for a treasury bill, you do not get any tax advantage. The reason number two is on the interest rates or the returns in these two options. A treasury bill will always have a lesser or a lower return compared to a money market fund. And this is the rationale. Money market funds respond to changes in the market interest rates as posted by the treasury bills. So it is the treasury bills that change first. Then the money market funds will trail the changes in the treasury bills, but slower, because the money market funds respond or change to the average interest rate of the treasury bills. And depending on the money market fund that you have chosen to invest into, the benchmarking of their returns also vary. We have money market funds that benchmark on the average return of the 91-day treasury bill, and we have other money market funds that benchmark on the 91-day treasury bill return plus certain percentage or several basis points. The most common is the benchmark of the 91-day treasury bill average plus 1%. Then we have number three, and that is the discounting and compounding. The treasury bill return is calculated on a straight line basis. The treasury bill does not compound. Those are two things. The return on the treasury bill is on a straight line basis. So it's just the percentage return multiplied by the face value. Then the tax element is adjusted. Then the resultant return, net return, is discounted. For money market funds, the return accrues on a daily basis and compounds either daily or monthly. So there is the compounding element in a money market fund, regardless of whether it is compounding on a daily basis or a monthly basis. And that one alone places the money market fund higher than the treasury bill. It will obviously make the money market fund grow your investment or returns faster, because the interest rates that are credited in your investment account on a daily basis or a monthly basis, they also get reinvested. While in your treasury bill investment, there is no reinvestment of that return. In actual sense, it is you, the investor, who will actively reinvest the discounted amount at the beginning of your investment period. And that's why we took the 8,122.6 discount from the investment in the treasury bill to reinvest it in a money market fund in order for that amount to compound. Then we have number 4, the trailer of the money market fund, or the trailing of the money market fund returns as a consequence of the changes in the market interest rate as posted by the Treasury bills. There is also an option by the fund manager in the money market fund of looking elsewhere and diverting their investments in the money market fund towards other options other than the Treasury bills or the government securities, which attract a higher return, or that will average and maintain a higher competitive return compared to the money market fund. That one has been witnessed in the recent changes in allocations of the assets in the money market funds when you look at the spreads, which diverted a lot of investments from the government securities towards bank fixed deposits, because the fixed deposits are giving averagely higher returns to the fund managers to the Treasury bill. There is a lower interest rate and reinvestment risk in the money market funds compared to the Treasury bill reinvestments. Lastly, but not the least, a money market funds can double as your investment vehicle and also a platform to hold your emergency funds because of the attributes of a money market funds, including accessibility, liquidity, flexibility, and affordability. On the side of the Treasury bill investments are quite illiquid. It is a process to access that money sitting in a Treasury bill. They are also not very flexible because they are auctioned on a weekly basis, unlike a money market fund that you can put your money at any point in time, while also you can also access that investment. But for analysis of the two options, we have to hold that those investments will remain without any access for the period in determination. But for purposes of expounding on emergency fund importance, the Treasury bill investments will not be very suitable for your emergency funds because Treasury bill investments lack those attributes that are so important for an emergency fund compared to a money market fund. So as a conclusion, you are far much better investing in your money market fund as compared to the Treasury bills. The Treasury bill investments cannot grow your capital to the desired goal amount compared to the money market funds. Thank you for watching and see you in our next video.